Unit 3, guys, we're looking at business. This is Mr. Hunter. First video here, we're going to dive into just some terminology. We're going to look at business types and growth. You can see here listed just on our intro slide, we have our business types. We're going to focus on 3 sole proprietorship partnerships. Corporations could be split into multiple categories, subcategories anyways, but we're going to keep it simple and just kind of look at it all as one corporation cluster. So keeping it simple, kind of wide scope look at this whole thing. But in terms of business growth, we're looking at different strategies that companies use to grow in terms of how they reinvest their profits, how they go more advanced strategies like forming larger companies through mergers or conglomerates. Let's dive into the sole proprietorship business type here first. Now, this is the most common form of ownership in the United States in terms of business. This is one person that is owning this company. Depending on the industry that you're in, this is usually fairly simple in terms of the legal process to form the business. You don't have to have as much legal paperwork because it's really just one party in here making decisions. And the other side of this is that the owner is going to be completely liable for the success or failure of this company, and is completely liable for any lawsuits that might come about, any debts the company takes on. The owner is liable for that. So in a sole proprietorship, you are taking on a little risk with that. But again, this is very, very common form of ownership for many small businesses across the United States and the most common type of business in the United States. Transitioning to partnership, a really similar format in terms of the liability. Now, this is the only difference is this is multiple parties. So this does complicate things a little bit. You're going to have more paperwork because you got to deal with the roles and responsibilities of all the partners. And that does bring us also to the general partnership versus limited partnership. So general partnership is where all of the partners within the company are acting in a role that's defined by their agreement and are part of the day-to-day operation of the business in some way. Typical general partnership would look something like one party handling the financial business side of the business, where the other is handling the day-to-day operations of the business. It does not have to be that way, but that would be an example of 2 parties involved in a general partnership. A limited partnership also presents an interesting perspective as well, because you come on as a limited partner and really all you're doing is providing a financial backing in the company. You're providing funds, you're acting as an investor and providing funding to help the business grow or start up. And you are, liable for those losses and the money. You can lose the money that you have, but you're not liable then for the debts or any potential lawsuits the company might take on. You're just putting your money out there, and then if you lose it, you lose it. But the goal would be obviously that the company does well and you make a big profit based on the agreement that you guys had set up as a partnership. Now, if you go a little bit more complicated, and as businesses start to grow, they sometimes will form corporations. There are different levels of this. There's even hybrid versions of the sole proprietorship partnerships and corporations with things like a limited liability corporation. So there are a lot of different things that we can look at to analyze this, but we're going to keep this pretty simple. Look at it just from a broad perspective. But a corporation is a business organization that is recognized as a separate legal entity. So it separates that liability from the person and the company that they're owning, which is a good thing for ownership. Takes some of the pressure off of that, especially as the business begins to grow beyond just one person's capabilities. But they are expensive to start. They're time intensive. You got to write a large charter, and that the state will have to approve, that would include all the aspects of the organizational structure, how this business is going to be run, what they do, how they do it, all of that information. And the reason why they're so rigid on how you have to come about presenting that is because you are offering stock. You're offering the public or a private pool of investors a potential to have partial ownership of the company through stock ownership. And just quick overview, again, we've talked about this before, but stock ownership comes from individuals investing in the company, putting their money out there. The company then uses that to grow their business. And as the company becomes more and more successful and larger, the stock price will go up. So the investors are making money through their stock ownership, and potential dividends paid back by the company. Now, the negative to this is the positives obviously being the separation of the liability, but the negative being the double taxation. So meaning that the company itself is taxed on its profits, but then all individual investors, the ownership of the stock, they are also taxed on their capital gains. So you get, you get the double taxation piece with that. When you're looking at a corporation. So looking at the structure, pretty simple here. Kind of ignore the bottom because this could vary from company to company, but essentially you're looking at a pool of investors as the ownership. These are the shareholders. They will somehow elect a board of directors that will kind of oversee and keep the business honest in terms of following what they're doing and that they're doing what's best for the ownership through the shareholders. They'll have some kind of a president and then other potential positions as well, like, a chief operating officer, chief financial officer, anything like that. There's all those different roles within that. All right. So that's the basic structure here. Lots of levels to be able to keep everyone honest and to do what's best for the ownership, because that is the purpose at this point. And if we break down the different types of businesses here and how they fit in the United States, most of them are sole proprietorships. All right. You see there 71.5% of organizations in the United States are sole proprietorships. However, the interesting thing here is over half of the profits coming through the United States are happening at the corporate level. All right. So, and you can see that really here, the bridge to that is here in the middle, seeing that 81.3% of sales are coming from just 18.5% of the organization. So that's an interesting perspective there. But most of the profits are coming from the corporations for sure. So most common is sole proprietorships. Most profitable is corporations. Definitely good to know. Now, in terms of growth, reinvestment, businesses are going to keep track of all their financial information through income statements, and they're going to keep track of their sales, their expenses, their, all the costs that are associated with their taxes. And then they're left with profits in the end. And the cash flow that results from that. And they're able to then take those profits and decide how they're going to distribute them. So this goes beyond like, okay, we made money, so now we pay our ownership or our management. This is everyone's already been paid. This is the funds that are coming in above and beyond those operating expenses. And with that, they can choose to do a lot of different things to grow their company. They can simply reinvest it into the company and create growth. They can pay dividends to their stock owners, which would encourage new investors to come in and buy stock with them because of the dividends they pay out, give bonuses to management. There's plenty of options that they can do in order to create a better situation and better growth for the company. A couple of the more advanced ways that businesses can grow are through mergers and conglomerates. So let's look at mergers here. This is where two or more firms combine together into one single firm. It doesn't have to be like explicitly stated. A lot of times the companies will pretty much appear on the surface to be separate entities, but they're owned by one company. And this can be done through a vertical merger, as with like U.S. Steel in the late 1800s, where you own all the stages of production. So all the resources needed to produce steel, every step of the way, Carnegie owned all of those. So it led to a cheaper product to produce in the end because of the ownership of all those different levels. Horizontal mergers are very common today within the banking industry. We saw it happen with Chase and JP Morgan, operating as two separate banks and then coming together as one. And that brought some benefits in terms of being able to provide some efficiency, combine resources, create new growth, and in some cases just eliminate a rival. Someone that was your competition is now someone that's helping you be more profitable. So mergers are good for that sense. And the last one here, we're looking at conglomerates. This is where a firm buys businesses that are really related products. All right. So, you can see here, this image is getting a little outdated at this point. There might be some changes to this, but, General GE, Procter & Gamble, all these companies diversify and own all of these. So you can see here, kind of blown up. You can see a lot of the big companies that operate as conglomerates and all of the sub companies that they also own. And you can see they usually kind of lump together. You can see in the box that they lump together as different things that, different companies are related. But yeah, so that's a conglomerate. We're looking at business types and growth. And next, we're going to be looking at market structures. So stay tuned for video 2 of Unit 3. Have a good one.